The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, so it is Thursday, the 13th of February, and I'm delighted to have Jeremy back. Welcome home.
Hi, Gareth. Yeah, good to be here.
Good to have you back from your travels. I was going to say you didn't miss much, but you did miss quite a lot.
There's a lot going on, isn't there?
There has been a lot going on. So I'm interested to get your take in particular, obviously, on what's going on across the pond and what ramifications that might have for the rest of us.
Yeah, so the Donald is stirring the pot, as he certainly did in Gaza. So his plan for Mara Gaza and basically tarmacking and turning Gaza into the Riviera of the Middle East certainly raised some strange glances at least and has caused a lot of ructions. And now he's moving on and dealing with Ukraine. So overnight we've heard that he has had a 90-minute conversation with Putin, and negotiations will start immediately. And he's obviously got the framework of a deal in his head, and I think probably a high-level agreement with Putin to move forward. This will be a settlement that he will conclude in a bipartisan way with Putin, for which he will expect Europe to pay for and enforce. And that is causing further ructions, particularly in the EU, but also in the UK, where there will be consequences. And I think the other interesting aspect to this is the reaction of China. There have been indications that Xi has said that he wants to get involved and even offering to host some of the talks that will be taking place between the US and Russia. You know, you follow the money in situations like this, and the real deal here, I think, will ultimately end up probably involving Trump and Xi. So, I think it's fascinating what's going on. You know, he's moving quickly in all manner of aspects of domestic and foreign policy, is Mr. Trump. It's deliberate, and he wants to get the reaction. And the rapidity of what he's doing means that the media can't really keep up. And out of this will fall outcomes. And the range of those outcomes is wider than we're used to, because the old world order is no longer there that gives us these norms. And I mean, where's the UN? You know, anyone heard from them in the last week or two? Well, no.
Not even mentioned. No. But it's incredible. I mean, it used to be the accusation against US presidents that they would use overseas, or they use foreign policy almost as a distraction from domestic failure or problems going on in the US. But actually, the way Trump's been behaving, I think he's quite proud of what he's achieving in the US. And I think he was slightly embarrassed by the inflation numbers. But actually, what's going on with Doge and supposed huge hollowing out of the federal government and the excessive spend. But in the meantime, he's also making real waves, in the Middle East and now trying to get the Ukraine crisis sorted. So he's wasting no time, as you say.
Yeah.
Have markets got any coherent reaction, or are they just watching and waiting? What do you think?
Well, oil prices have gone down, and European currencies and equities seem to be indicating that this is good news. So far, so good. You could point to the fact that the gold price is continuing this amazing bull run. One of the features of markets this week has been a new all-time high for the gold price, the first time it's been through $2,900 an ounce. And that indicates that investors believe there is something big to worry about. So investors see a wider range of potential negative outcomes from all this, amidst a wider range of potential positive outcomes as well.
Yeah, certainly the range of potential or even likely outcomes has certainly become more extreme with Donald Trump at the helm. I think that's right.
Yeah. So with this new sort of all-time high in the gold price, this has come amid further evidence of persistent US inflationary trends, with US inflation data this week, where all measures of inflation exceeded target and exceeded expectation. So this is a bit of a fly in the ointment for Donald. But while this would imply a higher rate level, and the market is now discounting, I think it's only 1/4 point rate cut in the US for the rest of this year, which is a big change.
Mm-hmm.
Yet to see this being accompanied by the move in the gold price is interesting and counterintuitive. But I think it's not just the risks that are taking place at a geopolitical level, but also indicates the risk of miscommunication and policy error between the Treasury and the Fed. So coming back to your Doge point, one of the interesting things about the Doge project is who they're going after. There's been quite a bit of interesting speculation around what Doge and Trump are actually going to do with the Fed. We've yet to really see much evidence of what the working relationship is going to be like between Treasury Secretary Bessent and Jay Powell.
Maybe that's where the gold investors see an element of risk. If that relationship really turns sour, there could be all sorts of ramifications. Yeah.
Yes, this was one of the features of Donald Trump's first term, was not just trying to direct the Fed and the Open Markets Committee into basically trying to do their job for
Push
them.
for rate cuts when they perhaps weren't warranted. Yeah, which
Correct.
Could be where we are now. Yeah,
exactly. So this move in the gold price is quite extraordinary, even in the context of the precious and monetary metals. So the wider grouping, including obviously silver, but also metals like platinum. So as Tom Stevenson in the Telegraph was pointing out today, there's something like 15 times as much silver underground as gold. And for most of the last few hundred years, that simple equation governed the ratio of the two prices. So 15-1. Today, the gold price is 100 times that of silver. So that ratio has really got out of balance. And, in terms of trying to price risk, where do you allocate capital given that expensive nature of gold relative to its peers? Well, things like platinum and silver probably offer better hedges of the same risk dynamic from here, I think is the point that he's trying to make.
No, very interesting. And it does feel like it's certainly moved away from fundamentals, and it's all driven by extreme risk or fear, perhaps. Meanwhile, China's been doing pretty well.
Well, yeah. And I heard you and George talk about the DeepSeek revelations a couple of weeks ago. What it does reveal is that the US and Silicon Valley in particular doesn't have a monopoly on AI. And this idea of American exceptionalism has almost certainly become overpriced in the context of the valuations and relative valuations of the Mag 7 compared to their counterparts in China. In the period since the DeepSeek announcements about the breakthroughs they've made in AI, Alibaba, a Chinese Mag 7, is up 44% in that time.
44% is extraordinary, yeah.
But it just shows you that real world markets and the economy are not the same as financial markets. They're different things. They run on different cycles. And there is clearly a huge disparity in valuations. And we've talked in the past about the dispersal trade where capital leaks from the Mag 7 into other markets. And I think this is almost certainly an example of that. Doesn't mean it's going to continue, but once it starts, this thing could gain really interesting momentum.
Yeah, China's clearly forced itself back onto people's radars in quite a spectacular way over the last few weeks. Yeah, as long as the dispersal isn't all in the direction of Chinese tech stocks, then the UK will hopefully benefit. And talking of the UK, we've had our own economic data this week. We've had
our own little economic miracle this morning.
It is 0.1%. Yeah.
Yeah. So who would have thought actually in Q4 last year, the UK economy grew. So, I think has been pointed out by Ambrose in the Telegraph again yesterday, that if you're a global investor sitting back and trying to assess the least bad places to allocate capital in the world, the UK still isn't a bad shout.
Sterling's doing okay. Yeah.
Sterling's doing okay. The 10-year bond is doing okay, relative to its peers, and credit default rate for the UK is significantly below economies such as the US. So again, comes back to the geopolitical points that in the new Trump era of heightened uncertainty, having tactical nous and the ability to print our own currency, borrow in our own currency, and have a few things going on. At least we might not have DeepSeek and huge technological breakthroughs, but we do a number of things quite well, and we get on and do them quite well. So if we play our cards right, I think the UK can be a very attractive home for global capital.
I'm almost seeing some Brexit benefit listening through there.
Perish the thought.
Yeah. Printing our own currency and
one day
charge our own interest rates. Keeping that's been pretty helpful, and keeping out of the way of the potential battles between Europe and the US in terms of tariffs or AI regulation, whatever it might be. It might be quite nice for us to be able to sit quietly on the sidelines. And if we can be on the sidelines of the big political dangers, but front and centre when investors are allocating their capital away from Mag 7, that would be a happy place indeed.
Yeah, and I think that's an interesting point you talk about, because in terms of having a government or having a series of policymakers that can set the scene, set the table for stronger economic growth, it's something that Starmer and Reeves and the government generally has been trying to prioritise. And one of those areas of where they can get out of the way of companies trying to make progress and grow markets. One aspect came to light this week where the ongoing saga in the motor finance industry was highlighted by the announcement from Close Brothers this week, where they quantified a £165 million provision relating to the whole issue, which has had a huge impact on them, but also an impact on some other businesses in the UK mid-market space. We had an update from S&U this week, which part of its business is in motor finance. And it was actually quite an encouraging statement, talking about how they were seeing a more balanced and pragmatic approach to government regulation and policy, and the prospect of a more stable framework for their industry. This sort of reflects the noises being made by Rachel Reeves and others in government that they wanted to box off this whole issue so that the industry can deal with it quickly and move on. The writing on the wall is that the government is going to get its arms around this issue and sort of box it off for people involved in the UK market. Well, obviously, a couple of progressive clients are involved in that space as well.
Yes, Secure Trust Bank have been a bit impacted by the risk that's still there. And absolutely, as you say, if Rachel Reeves or the rest of the government could help by just literally keeping out of the way or making sure that this Motor Vehicle Commission issue doesn't turn into another PPI debacle, then that would be fantastic. That would be a real win. In a slightly similar vein, Virtue Motors, they had an update at the back end of last week. It was quite cautious, actually, in a number of areas. In particular, they are seeing pressure on used car margins, but they're also describing the fact that the government's electric vehicle mandate is really confusing the market. It's making consumers' decisions difficult to make. It's also leading to difficulties for the car manufacturers and the retailers. So it's really impacting on that new car market as well. And again, that's perhaps another area where government oscillation on policy, or will they, won't they change the rules, or the timing is really impacting on the real world. So again, hopefully, if the government is minded to try and help get that industry moving again, that would be another area where they could make some quick decisions, get some clarity into the space, and industry can get back to moving again and hopefully some growth.
Yeah.
Well, great. That's been a fantastic wrap up. Lots going on. What have we got on the radar for next week?
Well, on Wednesday, we've got UK inflation data for January, where obviously on the back of higher than expected inflation from the US this week, I would suggest that given our sort of slightly more sluggish economic growth, we won't follow the US into a surprisingly strong print. So we're running at 2.5% annualized inflation in the UK currently at the moment. And I think that's most likely to be unchanged for January, which I think would probably be good enough. And on Thursday, we've also got inflation data from Japan, which I always go on about, everyone's forgotten about, doesn't seem to be moving the needle. But Japan is probably going to be reporting an uptick in inflation from 3.6% to 3.7%. And one day, the market's going to wake up and say, this is unsustainable given where Japanese interest rates are. And it's going to raise the prospect of the yen carry trade and the fact that this particular mechanism is financing all kinds of stuff elsewhere in the world.
Always worth being aware of, because that might well be one thing that even Donald Trump can't batter into submission. But we'll see what happens. Good stuff. Okay, great to catch up again, Jeremy. And we'll speak this time next week.
Okay.
Talk to you then.
Brought to you by Progressive Equity.